Welcome back to Investing Talk Podcast. Today we're looking at DraftKings. As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you look at DraftKings, the picture is, well, it's a classic modern growth story.
Right.
It's defined by this massive revenue acceleration, which has been, extremely impressive. But it's also constantly fighting off these temporary but very real cost pressures.
The cost to acquire customers.
Exactly, as they race to get market share in all these newly regulated states. Let's start with the top line. Their recent quarterly revenue number, that was Q3 2025, it came in at $1.14 billion.
Okay, $1 billion.
Which is a significant 44% jump year over year.
44%.
Yeah. And even though management, they slightly adjusted their full year guidance down a little.
I saw that.
Right, to the $5.9 to $6.1 billion range. That still represents a substantial leap. It's around a 30% jump from what they pulled in last year.
So the revenue machine is definitely running hot. But that growth sounds phenomenal, and it's what grabs headlines. But the biggest question, the one that always hangs over these kinds of companies is, are they actually making any money?
And that's where the picture gets a bit mixed. It's where the cost of that growth becomes, painfully visible. The adjusted EBITDA for Q3 2025 was a loss of $126.5 million.
Wait. So revenue grew 44%, but their losses actually grew year over year. That sounds like a red flag. What's driving that?
It's not necessarily a failure so much as a strategic decision.
Okay.
Management said that higher loss was primarily due to really aggressive promotional spending.
Buying customers.
Buying customers, exactly. And heavy R&D investment to keep their tech platform ahead of the curve. So margins are absolutely under, temporary pressure. But here's the key metric Wall Street is laser focused on now. The turning point everyone is tracking is Q4 2025.
This coming quarter.
Right. The earnings per share consensus is sitting at about 16 cents.
Positive 16 cents.
Positive. And if DraftKings hits that, it marks a huge swing toward the company's first ever quarterly profit. It changes the whole narrative.
And if they miss it, the market will probably punish them severely. So, they need a solid foundation for this. How stable is their runway?
It's actually really robust, which gives them a ton of flexibility. Their balance sheet is net cash positive.
Okay.
They're holding about $2.2 billion in cash versus $1.35 billion in long-term debt.
So they have breathing room. They don't need to keep tapping the markets for money.
Not at all. Now, their free cash flow is negative right now because of those big investments.
Right.
But management has set a very clear target. They are aiming for free cash flow break-even in 2026.
And that feels achievable.
Highly. As these state markets mature, they can pull back on all the heavy promotions.
That strong balance sheet lets them keep building out their competitive advantage, their moat, as people say. What's that moat actually made of?
It's really a few things. First is just market leadership. They're number one or two in almost every single U.S. market.
Right.
Second, it's their tech. And third, it's those exclusive access deals they get in key states. It's really hard for rivals to replicate that.
And you can't forget the big partnerships, right? The NFL, the NBA.
Yeah.
That keeps them front and center.
Absolutely. The spend per user in mature states shows that once they get a customer, that customer is very valuable and, very sticky.
Okay, so let's shift to the technical side, because the fundamentals might be improving, but the stock price has been a total roller coaster. It corrected sharply from those summer highs near $50. Right now, it's sitting around $29.64.
It's been volatile, for sure. But the important thing is what's happened more recently. The stock seems to have found a floor, kind of consolidating in that $28 to $32 range.
Yeah, technically $28 is acting as pretty strong support. You have short-term resistance at $32. And then the next big level is $36.
And it's hovering right around the 50-day moving average, which is about $30.
It is. But if you look at the longer-term health meter, the 200-day moving average, that's way up around $38.
Right.
The fact that the price is still below that tells you the market still sees this in a technical downtrend, even with the fundamental story improving. A breakout over 38 would be huge.
That's a great point. And if you connect that to institutional sentiment, the picture is still pretty bullish despite the price drop.
What are the analysts saying?
The consensus is a moderate buy, and the average 12-month price target is, well, it's ambitious. It's $52.83.
Wow. So that's implying what, like 60% upside from here?
Roughly, yeah.
Yeah.
So Wall Street thinks this pullback was temporary. And what's really interesting is the institutional flow. You're seeing huge players like Vanguard and BlackRock growing their stakes.
The so-called smart money.
The smart money's buying in, yeah. They see a long-term scale advantages.
And speaking of confidence, management is signaling it pretty loud and clear. They just doubled their share buyback to $2 billion.
A massive number.
It's a huge signal, especially after the stock fell 36%. Management is basically saying, we think our stock is cheap right now.
And they're backing that up with aggressive expansion moves, like the recent acquisition of Railbird.
Tell me about Railbird. That news caused a pretty sharp rebound in the stock, so the market obviously liked it.
It's a really big deal. It's their entry into the U.S. event contract prediction markets.
A whole new vertical.
A whole new vertical. And Railbird is regulated by the CFTC, the Commodity Futures Trading Commission.
Okay, so they're buying their way into regulatory compliance.
Instantly. It diversifies their revenue away from just sports betting into, a potentially higher margin area.
A very smart play. But we do have to acknowledge the skepticism. Some analysts are still tapping the brakes, lowering targets to that $36 to $40 range. Why?
It really comes down to those two things we mentioned. First, the cost wars with FanDuel and BetMGM aren't stopping. There's a fear that could permanently hurt margins. And second, that slight revision down in revenue guidance. It made some people nervous.
Right. So that makes the near-term catalysts even more important. Looking at the next 3 months, what are the triggers that could push the stock toward that $38 breakout level?
The biggest one, without a doubt, is the Q4 earnings report, probably in February.
That's the one everyone is watching.
Everyone. If they hit that first ever quarterly profit, that 16 cents a share, that could be the trigger for a major rally.
And beyond earnings.
You're watching for two other things. One, any updates on state expansion, big markets like California or Texas.
The holy grails.
The holy grails, exactly. And two, new product rollouts like iGaming features that can boost revenue from existing customers.
And you always have those long-term strategic rumors floating around, a potential partnership or even an acquisition by a media company or a league.
That's the chatter that's always in the background. But we have to balance that with the real risks. The number one risk is still those rising operating costs, the promotional spending.
You have to be comfortable with the cash burn for now.
You do. And the other risk is always regulation. A sudden tax change in a key state could really hurt profitability overnight.
So if we pull this all together, the growth, the balance sheet, the path to profit, the strategic moves, what's the final investment thesis?
Our overall take is still firmly bullish. I'd give it a high rating, driven by that rapid growth and market leadership. Wall Street clearly sees a lot of upside as the U.S. market matures.
So it's for two types of investors, really.
I think so, yeah. It appeals to short-term swing traders who want to play the earnings catalyst, and also to long-term owners who are just capturing that whole secular growth story of digital gaming in the U.S.
So ultimately, the question for you to mull over is the core tension defining this stock today. Will the strategic investments in R&D and promotional spending finally translate into the crucial Q4 profit that analysts are projecting, providing the catalyst the stock needs? Or will the ongoing competitive cost wars continue to delay that break-even point and challenge management's 2026 profitability timeline?